Trading the yield curve today at the small exchange. We have two new products that we just threw out there for everybody else to go along with our small 10-year product. We have the 2-year and 30-year added this week, and to great degrees of people excited about trading the yield curve. The spreads in those markets have been 2 or 3 pennies wide, which has been really fantastic to see from our end. Products working exactly the way that it should be, moving higher and lower with yields in the market. And with those products being launched from the small exchange this week, we wanted to go deep on trading the yield curve, why you might look into it, how you can do it now with relative ease and simplicity, thanks to these small exchange products. And then finally, at the end of this, I want to go as deep as we possibly can without hopefully scaring you away to talk about steepeners and flatteners, NOB spreads and TUT spreads, a lot of words that hang around the active trader's vocabulary that maybe you haven't really tapped into fully because of complicated traditional products. We make it as simple and straightforward for you to trade these yield curve products here at the small exchange. We're going to get into all of that, but first, let me put in front of your eyeballs a disclosure. You don't have to read it. You should read it, or else, yeah, I'm already in trouble now. This is from our compliance team, letting you know all the different information around the small exchange, and I feel like I gave you enough time to read this now, so let's move on to the fun stuff. I wanted to kick off today's presentation with a question here, and you're probably going to know the answer because it's a bit of a leading question, but in blue there, you know, if I'd asked you earlier this week before we launched these yield curve products or earlier in the year, what that blue line was that is outpacing crude oil, tech stocks, and ags here in 2021, I don't know if you would have necessarily gotten it right. And it's really a fun thing to see from our side. We're making these futures products on anything that you, the everyday trader, wants to see. And we love when we start to get emails and feedback like, oh, I'd love to see an agriculture product, because that means that everybody is tapping into these new these new markets that aren't just the straightforward stocks that I think a lot of people cut their teeth on in trading. But what's interesting is everybody wants to talk this year about corn or crude oil up huge this year, back to about $60 a barrel. Really big rise from, at one point, one of those futures products in crude going below zero last year. And we love to see it. But something that people maybe haven't noticed is the fact that interest rates are actually the hottest market, not named Bitcoin right now. And with that being said, I believe this morning, on a percentage basis, the 10-year is actually up more on the year than Bitcoin is, given the fall the last couple of days in that cryptocurrency and the continued rally here in rates. And of course, the active trader knows, oh, the product that's up the most doesn't necessarily show the greatest opportunity. But I wanted to highlight this because for whatever reason, we think at the exchange it's because products of old and interest rates are too confusing or too big. But for whatever reason, people aren't really taking part as much in this interest rate conversation as they are in crude or tech stocks or cryptocurrencies or even agriculture markets that a lot of people, like I said, are getting more and more interested in. And I think that part of that problem is the fact that traditional futures can make it hard to see this opportunity. You know, when you pull up a ZN, or this is the ZB future here, the fact that it fell from 180 to 165, I don't know a ton of people that can tell me directly what that means and what the opportunity is there. But when you read in Wall Street Journal, Financial Times, or just on Twitter, wherever, that, oh, interest rates have moved from 1% to 2%, that means something to me. So these traditional futures can make it very difficult to even sense that there's a lot of movement in this market, or that it's moved to a new extreme, a new area that it hasn't been in a while. Not to mention that this traditional futures market here is a $160,000 product. You know, that turns a lot of people off, even if you say, oh, the product only moves around $500 or $1,000 per day. It doesn't move $160,000. No, that product being that large, very rightfully so, scares people off, because you know, you get the outlier risk there of this market actually, you know, moving, doubling or collapsing in half. And that's, thousands and thousands of dollars. So for all those reasons, I think people kind of miss out on the fact that this interest rate market is, in my mind, one of the most opportunistic, one of the most high-flying markets of 2021 so far. And with bond ETFs, it's a distinct problem here, but a similar one where it's like, all right, the TLT ETF fell from 170 down to 145. I'm in interest rates. What does that even mean in rates? I have no clue. I can't make a story out of that fall. And also, anybody who's traded shares or options on TLT knows this. The fact that it's a low volatility market, showing an implied volatility usually between 5 and 10% on a product that's $140, $145 right now, that means I'm not getting a lot of movement for having to put up a lot of capital to trade the shares of stock or to trade the options on that. Even getting that options leverage, a lot of times you find this conundrum of like, oh, I'm going to sell this Strangle or Iron Condor or even Straddle, and I'm getting like 60 cents or 70 cents, and they're asking me to put up a couple $100 or even $1,000. It really just doesn't seem worth it there with the high capital requirements for trading in the low amount of movement here in these bond ETFs. But when we put in front of you, this is the S10Y future that we launched a couple months prior, and it's been doing really well. Just consistent volume, consistent interest, people getting in there and wanting to trade this thing around. I can make so many different stories out of this product. All we did here, we didn't reinvent the interest rate or the whole asset class here. All we did was simply say, hey, what are you used to referencing this market by? What are you used to seeing here? Oh, okay, that's what you're going to trade. This is an interest rate market that looks like those interest rates. And right off the bat, I can see, oh, wow, rates are all the way up to where they were pre-pandemic. And that's when everybody knows the Fed cut interest rates all the way down to zero. So right there, I've got this story of back to those pre-pandemic levels. While traders are pushing against the Fed's 0% policy, as recent as yesterday, the Fed comes out and says, hey, we have no plans to lift rates off of 0%. Well, looking at this chart right here, traders out there, the everyday investor and trader, self-directed, has a lot of plans for these interest rates to move off of 0% because they've rallied all the way from $5 here in the product, which is 50 basis points or 0.5%, all the way to where they stand right now today, actually at $14. They've done rallying since I generated this graphic. That's 1.4%. They've added almost 100 basis points with the Fed doing nothing over the last 6 months or so. That is a huge story right there that you don't get from those ZB futures or the TLT ETF shares. And they're moving the most that they have all year here in 2021 and for the greater part of 2020. There you can see just, gobbling up 10 basis points here at a shot, which is $1. We saw even this morning, the product that we just added, S30Y, was up $1. That's a 10 basis point move in a day. This is a market that I really, since I've started, working in this whole universe and I've gotten away from trading at a prop shop at the Board of Trade, I've always advocated for getting people into the interest rate market because of course, the diversification, but it gets this negative connotation like, oh, interest rates are boring. They're part of my my loans or part of whatever. It's not exciting. Look at this chart and try to pull up another market that has increased from $5 to $14 here, over 100% rise. It's a lot of different intriguing angles here in rates. And what's really great here, a problem that those Bitcoin traders and a lot of people struggle with is, wow, Bitcoin, that market's up huge this year. That's intriguing. There's a lot of opportunity there. But the Bitcoin futures are big. In the actual cryptocurrency platforms there, when you're trading the actual coins themselves, you're not getting efficient margining. With this yield product, very small, efficient size at just $1,300 or $1,400 now with the rally up to $14. A $1,400 product relative to that ZB future, like I said, $160,000 product. I don't know anyone that if I was talking to them at a bar or here to you on this on this live stream that if I made the case for interest rates providing opportunity in trading, and then I told you, oh yeah, well here's the product, it's $160,000, that would throw everybody off. So small product, and that correlates to a small margin. This really looks to me like a stock, 100 shares of stock that's between $10 and $20. And what's really nice about that is trading that stock that's between $10 and $20 is going to cost you, per share $5 to $10 to trade. No, you're trading this actually at the cost of a $2 stock thanks to the efficient margining here in futures. So that small tenure that we went out with, small size, small margin, and then we added these two different ends of the curve on top of it with the 2-year and the 30-year, varying price points that move directly with the actual yields themselves, and that's why we have a really small 2-year product, and a lot of people have been loving that here in the first 2.5 days of trading, because when do you find a futures market that literally is under $200 in product size? I don't know of one that exists. If you do, hit me up. But with that efficient margining, now I'm getting to test out interest rates in a margin that's under $100. That's really, really great stuff, and something that I come back to often. And maybe if you've watched our small exchange stuff here in the past, you've heard this analogy, and I'm sorry if you have, but it's really like when you go into that ice cream shop and you want to try something out. You've never had ice cream before in your life because you're a crazy person. I don't know. And when you go to test it out, instead of giving you that small little dainty spoon, they give you a big tub of it. That's like what it feels like, what it's felt like for the past decade of, hey, I want to try out futures. I want to try out maybe these interest rates. And I get in there and it's like, oh, here's $100,000, a $200,000 product. I mean, looking at that 2-year, that's $100 product size, margin under $100 from the small exchange. The 2-year future ZT from the CME there, it's actually over a $200,000 product because the multiplier there is $2,000 for that future. Once again, just like those products, and I don't mean to throw shade on the CME, because guess what? Those products weren't made for you. They were made decades ago for the institution. They were made, I think the first bond future was made by the CME in the 70s. So they, of course, didn't anticipate 2021 interest rates are moving. Everybody's talking on Reddit threads and talking on Twitter and all this stuff about the self-directed traders opportunity. Of course, they didn't anticipate that in the 70s. But what we said here in 2021 was, why hasn't anybody worked to change that? And that's what we did here by reducing these sizes, letting you get in to try it out for even that bigger, the 30-year, which, if anybody knows anything about interest rates, that longer term, longer duration Treasury product is usually thought of as having more whip, more volatility, more back and forth. Even that bigger, more volatile product, just $2,000, $300 in margin to try it out. So you can truly test out this new asset class with ease. Different sizes here. I was just talking about my colleague and friend Peter Momat was just telling him, it's like Goldilocks rolling up to that table with the different porridges. You don't get one size here where it's a $160,000 product, like it or don't. No, we gave you a few different sizes here so you can get comfortable, at least try out the yield curve. And if you don't like it, that's totally fine. There's nothing that I can do for you beyond that point. But the everyday trader now has the entire yield curve to trade in products, and all these products were made for them. And so now I want to get a little bit out of the specs and the sizes and all that stuff that I think is interesting, but I don't know if the everyday trader necessarily thinks is too interesting, and get into the opportunities themselves, because it isn't a matter of we created a Treasury Yield product and we just created 3 sizes of them. They're very distinct. You look here at that gray line in the 2-year, that product actually until today was down on the year. That 10-year on the flip side of the spectrum, up like 30% on the year. So these products are very different for being the same asset class, essentially the same asset, just a different duration here. And the opportunity thus is very different, and that'll get into in a little bit why we trade these spreads, why there's so much opportunity in that. You can see it right here, a little tease for it. You can see that difference between the gray line and the black line. That's that TUT spread, and that's why people are always talking about steepeners and flatteners, TUTs and knobs, is because that's a really intriguing trade. Wow, the 2-year yield is only at 10 to 20 basis points here, and the 10-year is up at 140. Wow, that's a huge difference. That's an intriguing trade right there. And so we're going to get into those steepeners and flatteners, but I just wanted to show you here how distinct the opportunity is among these differently sized yield products from the small exchange. And now let's go back to where we started. Remember how the 10-year yield is outpacing these seemingly hot markets up after yesterday and today? It's actually up closer to 40% on the year. Well, what if I told you that its highly correlated short-term brother in the 2-year is actually down until today, was actually down on the year? Huge variance in performance here. 10-year is up 40%, the 2-year down 10% as of a couple of days ago here. And this is where the distinct opportunity in itself comes in, and what we've loved in just having launched these products 2.5 trading days ago is we're not seeing people just continue to focus on S10Y because that's the one that we launched with, or people going straight to S2Y and just staying there because that's the smallest one, or going directly to S30Y because that's the more volatile piece that maybe has the more intraday opportunity. We've seen interest spread across all 3 of the products. We love to see that, and it's because each of these 3 have their own distinct opportunities. That 10-year, you might say, well, seems really messed up because the 10-year is the outperformer of the 2 and the 30-year. I mean, I could understand the 2-year, being flat on the year, the 10-year being up slightly, and the 30-year being up the most. What's interesting is that 10-year is really the global benchmark when it comes to duration. If you're looking at the Wall Street Journal, what yield are they quoting? The 10-year yield. Any of these articles that you're usually reading, that 10-year is the benchmark, and I can tell you from experience, it's the first place that traders go. When I was at the Board of Trade, all of the spreads that I traded almost inevitably had the 10-year in it. 2s against 10s, 5s against 10s, 10s against 30s, 10s against euro dollars. It is the first place that a lot of people go because it is truly that benchmark. And so when you see a big rally in interest rates, the Fed comes out and says, oh, we're hiking rates, that 10-year yield is usually going to see a bigger rally than everything else. When they say, oh, it's doom and gloom, rates are going to zero, you're going to see a bigger proportionate sell-off in that 10-year. So a unique opportunity in that its own right. The 2-year, you can see as recent as this week, battling what the Fed has to say because it is that short-term trade. Why has it been down on the year? Why is it not seeing the upside? Because the Fed has said, hey, we're holding short-term rates at 0, and so we haven't seen this 2-year yield take off. Now, this week, we're seeing people come in and battle the Fed. That's its own distinct opportunity there in the short term with S2Y. The 30-year, to me, that is a great intraday trade. If you're trying to day trade rates, you're trying to use the small yield curve for some day trading opportunities, S30Y is the spot for you because that's the one you saw it this morning. Yields rallying across the board. S2Y was up about 20 cents. S10Y was up about 50, 60 cents. That 30-year got all the way up to $1.15 higher, and then it came all the way down. The word that's usually used there is it's whippy. It's got a lot of whip to it. And so that's its own distinct opportunity where it's not seeing the heights of the 10-year, it's not seeing the lows of the 2-year, but on a daily basis, a lot of volatility, a lot of opportunity. With that, I want to get into the opportunity between these interest rates, and this is where the nerds come out, and I love to see it. I got emails just this morning from people asking about, what's the ratio in the NOB spread? When do I want to put on a steepener? Or when do I want to put on a flattener? I'm loving to see people starting to get interested in this. It's going to take some time before this becomes, at the end, if we do our jobs right, this will become secondhand nature to you in the same way that, stocks are bullish or bearish today. you'll be able to tell yourself, your friends, your family, anybody who wants to listen or doesn't have a choice, oh, steepening in the yield curve today, or oh, flattening in the yield curve today. And here's the basic definition that I like to ride with, which is when you're seeing steepening, that just means that these rates are diverging. And by that, I mean the difference between rates is getting larger. And it kind of makes sense. Steepening, okay, it's if, the S2Y is at 20 basis points and the S10Y is at 100 and the S30Y is at 200, and the differences there go from 80 to 100 basis points to 150 basis points of difference. Maybe that 2-year stays at 20. Now the 10-year goes all the way to 150. That's steepening. Those interest rates are widening out. Flattening, also that term seems with the older products. I could tell you from firsthand experience, trading the Treasury futures in bond prices and note prices, it seemed backwards almost. It's like, oh, flattener, so I want the prices to actually diverge, and then the yields, they converge. No, it's really simple here. Flattening in the small yield curve is simply those rates coming closer together. And think about that yield curve, those three different pieces, 2s, 10s, 30s. If they come closer together, that curve that usually is upward sloping is getting flatter. It's moving to a flatter piece there, and we can actually even look at that with our little yield curve animation here at the end of this segment. Hopefully I can kind of draw your eyes to that and you can envision it a little bit better. But those distinct opportunities that I just laid out between the products individually set up for this world of steepeners, flatteners, and even inversions, that's when a certain spread on the curve gets so flat that it actually goes inverted, which a lot of people talk about as, oh, it's a sign of economic turmoil and all this different stuff for equities. Well, guess what? Now you have the products to trade that inversion. No longer is it just a piece of your research. Oh, the curve went inverted today, and so that means XYZ for stocks. No, you can go directly to that inversion when they occur and trade them very simply, very easily with the small yield curve products. So this is the 2-year, 10-year spread. It's called the TUT. And what you'll notice is it looks a lot like the yields themselves. Like if I backtrack a little bit here, sorry for this awkward looking transition. But if I go back to just the price movement in the yields themselves, you see that, oh, the y-axes are yields. And so with the lines moving higher or lower, I know that yields are moving up or down. When I go to this TUT spread on the graph here, it looks very similar because it is a yield in and of itself. It's the yield difference. And so this TUT spread being at, right now sitting around $12 because S10Y minus S2Y is $12. That's just 1.2%. I know it might seem a little bit convoluted if this is the first time you're learning about flattening and steepening here today, but trust me, you'll hear about this, the 2s, 10s, or the 10s, 30s that we're going to get to in a second. I would be very surprised if by the third or fourth time you came across this relationship, you didn't be able to pick it up immediately what it meant. And so this is what steepening looks like. The difference, as you can see, going from $8 there, or 0.8%, all the way up to $12, or 1.2%. They're steepening in those yields. The difference between those yields is getting larger. This TUT spread moving higher here. And now I'll go over to, which is a cult favorite, the NOB spread, 10s, 30s. And why is it called the NOB? Well, traditionally, it's the 10-year note and the 30-year bond, and so it's notes over bonds. We'll still hang out with that nomenclature for the moment, but this NOB spread, you see, very different. It's not just this straight shot higher, because what have we seen? What has really been moving the steepening in the TUT spread? Well, it's 10-year rates moving higher and that 2-year rate not moving at all. It's all part of the same three prices that I've shown you several times here. Nothing new or weird is going on. It's just a matter of taking that 10-year that's ascended 30 or 40% and subtracting from it that 2-year that hasn't moved at all year until just this week. This NOB, you're seeing a lot more back and forth. this isn't just straight up steepening. This is steepening and flattening throughout the last couple of months here, which is great. And this goes along with what I spoke of earlier, which is this bond is really, to me, a great intraday trade. This NOB spread, to me, is less indicative of like where the economy is going. The TUT spread is a lot better for that. When the TUT goes inverted, that means a lot to a lot of people. When the NOB goes inverted, those 10s and 30s, though there's 20 years of difference, they're really closer. I would contend are closer products than the 2s and 10s. Those can be very different. And so with that being said, the NOB to me is like a great intraday trade or a great short-term play over a couple of days where it's like, take for instance, let's just look at the end of January to early part of February where this spread went from $7 of difference all the way up to $8. And then we saw some reversion, some back and forth in here. This is one where I'm just looking for big movements in flattening or steepening, not necessarily looking to put on those longer term, like, oh, I think the curve is steepening in the next couple of weeks or months. I usually don't go to the NOB, but a very fun trade in and of itself. And yeah, you can see the difference here. This is the TUT, just pretty straightforward, steepening throughout. And here the NOB, you got some steepening to start off 21, then some flattening, and then a healthy amount of steepening. We're seeing more flattening the last couple of days here. And so, yeah, those are the ideas behind steepeners and flatteners, what they look like in the market. And then I also want to leave you with how you trade them. Like, for instance, and this is, to me, I maybe take this for granted because I have been around these products for so long, but when you're thinking about, okay, I'm looking at this TUT spread, and I think that it's going to continue to steepen, what do you want to happen? Think about the two pieces there and what you want to happen. Well, I want that 10-year to move higher, and I want that 2-year to move lower, or they both move higher, and the 10-year just moves more higher. Not the right way to say that, but you get what I'm saying. And thus, I want to buy S10Y and sell S2Y. That is my steepener. Maybe I think that the steepening has gone too far, and I think there's some flattening in order with this TUT spread. What do I want to happen? I think that S10Y is going to come back a little bit, or that S2Y is going to rally harder to meet it. So what do I want to do? I want to buy S2Y, and I want to sell S10Y. It's really as easy as that. The steepener being buying the longer term piece and selling the shorter term piece. The flattener being vice versa of that. I'm buying the shorter term piece and I'm selling the longer term piece because I want that yield curve to come in and flatten and those rates to get more similar. You could think of that flattener here this afternoon with S2Y at about $1.25 and S10Y around $14. Flattener means I just want those prices to come together to start to look like they're going to meet each other. And so what do I want to do? I want to buy that cheaper one, that $1.25, and I want to sell the more expensive one at 14. That's me putting on that flattener here today with the 2s and 10s, the TUT, using the small yield curve. And yeah, this is our whole yield curve here in a nice, cute little GIF as you watch it go to flattening. Oh, there's some inversion. That's the normal curve that you see, upward sloping, flatten, and then inverted. And yeah, interest rates, they aren't new. They've been around forever, and they're not necessarily in vogue right now. Like I spoke of earlier, a lot of people interested in, oh, you guys should do an ag product, or, oh, you guys should do a crypto product. And we're working on all of those, especially that crypto. You'll hopefully see that soon. They're not what Elon Musk is tweeting about, though I would contend interest rates have a lot to do with Elon Musk's business, and they're going to mean a lot for Tesla moving forward. Interest rates aren't those things right now, but they really do move, and I can't say this enough. This is going to be a really cool trade as interest rates continue to heat up. I think you're only going to see more people talking about interest rates, talking about flattening and steepening and the Fed and everything else. So I really want you people to try these products out. They're very, low margins, low cost to try out, and get in while the opportunity is still young and fresh here. And I really think that you'd be doing yourself a service because these markets are moving, and they've shown in the decades prior that when they do move, a lot of opportunities. So there's trading the yield curve here at the small exchange. Hope you love the presentation. Hope you love the new products. Thanks.